equity transactions, but over the years, we've greatly expanded our coverage to venture capital, M&A, and public markets data, as well as funds, service providers. Essentially, the whole deal-making ecosystem is kind of what we cover. We are also a subsidiary of Morningstar, and so we have a bunch of data sharing with our parent company. So a little bit about our team. So our job on the quantitative analyst team is to leverage the PitchBook's data to gain meaningful insights that may be a little bit harder to tease out at first glance just by looking at the data. And we also try to contextualize the PitchBook data by bringing in external data sets, which you'll see kind of peppered throughout this presentation. And that just helps us demonstrate how the different aspects of the industry fit together and how they kind of are a piece of a broader whole, because as we know, nothing happens in a bubble. And so in this particular report, we're looking at the U.S. venture capital landscape with a specific focus on the last 2 years for obvious reasons. We're going to look at how the industry reacted to COVID from an activity perspective, and then we'll cycle through some of the forces that we kind of see as the things that are underpinning what we've been seeing from an activity perspective. So with that, I'll just kind of jump into it. So, I think coming into particularly March of 2020, when COVID started to really affect things on the on the U.S. side, there was just a ton of uncertainty across the board. Whether it's venture capital or literally everything else, we're all kind of experiencing. Many of us moving to remote work for the first time and having to deal with that, and so there were big question marks as to, okay, what effect is that going to have on the venture funding landscape. And interestingly and kind of unexpectedly, what we actually saw was 2020 ended up being a record year as far as capital invested across companies in the U.S. Despite the fact that there were these massive headwinds that we experienced early on in the year. And beyond that, even more surprisingly, 2021 has just, as you can see here on this chart, completely blown out of the water 2020 already. And this data is only looking through 3 quarters worth of deal activity. So some pretty interesting developments there. And one of the things that we have been hearing a lot and is a little bit harder to quantify data-wise is the pivot that venture capitalists were able to make to using remote technologies. So we all became very familiar with Zoom. So did venture investors who were looking to deploy capital. Sort of the conventional thinking was, hey, this is a sort of a handshake deal, kind of an industry, and it's going to struggle without those in-person meetings and some of those due diligence meetings with VCs traveling to meet companies. But in fact, the VCs seem to embrace the remote technology and really kind of lean into the Zoom world. The rest of us have also been forced to embrace. So looking at deal flow again here on a monthly basis, what we're looking at here is monthly capital outlays to startups in the United States. And so you can see in March of 2020, we're still sitting just over that trailing 4-year average of capital invested per month. And then there's a slight dip in April, and that's sort of when things were still pretty up in the air. But ever since then, every single month has just been, completely blowing things out of the water. In 2021, we have 5 months that have eclipsed that outlier December number in 2018. So some pretty incredible numbers that we're seeing coming out of that really uncertain time at the beginning of 2020 with COVID hitting. So definitely caught us a little bit by surprise, and I think that's the general sentiment was for a while, but now everything's just kind of moving along, and there's a ton of capital out there in the market. And so now we're going to kind of shift to a couple of the underlying causes that we think is driving this massive amount of activity in the ecosystem here. So I'll pass it over to you, Alex.
Yeah, so here you're looking at the yield curve spread between the 10 and the 2-year yield in the U.S. Over the three, most recent financial crises, the crises that are in recent memory, the dot-com bubble, the global financial crisis, and the COVID-19 pandemic. And what we're seeing is that the yield curve coming out of the crisis has been flat and has been flatter than other crises over time. And we attribute this to lower yields on the long end of the curve. And one of the reasons that we believe we're seeing so much VC deal investment is just that investors need to find yield in other places in the modern day. We've seen a trend over the last 30 or 40 years of yields decreasing steadily. And so when we look at what LPs might be searching for in yield, on the left here, we have U.S. pension plan return assumptions versus the 10-year Treasury, and you can see the gulf between these two widening over time. And so LPs need to make up this return in other places. And on the right, you have the yield curve over the last 20 years, demonstrating that yields have continued to come down even on the long end of the curve. So if you are an LP that needs to target a return of 6%, 7%, it's difficult to find yields over 3% or 2% in the last 10 years. So investors are keen to find other asset classes or opportunities to deploy capital and make up this return difference. And as we continue on here, so let's look at the direct impacts that these rates have on aggregate VC deal value. So on the left, on the y-axis here on the left side of the screen, you have aggregate VC deal value in real terms, so adjusted for inflation. And then across the bottom on the x-axis, you have the 10-year Treasury rate. And, theoretically, you would expect this relationship to be pretty strong because as rates go down, investors need to find more yield, so VC investment should go up. And also, the carry trade between borrowing at cheaper yields and investing at theoretically higher yields is more interesting. There's a greater return there. So while theoretically you would expect this relationship to be high, it's actually not as high as we'd expect at an R-squared value of 0.38. So there is a relationship there, but it's not as strong as we'd expect. I think that what is likely driving or contributing to the VC deal size or the aggregate VC deal value that we've seen recently is actually due to the public markets. So if we look at the relationship between the percentage changes in the Wilshire 5000 and VC deal making, what we see is that the relationship is much stronger. When markets outperform, investors are investing more in venture capital. And we believe this is due to the denominator effect, which it's the effect that occurs when public markets outperform and investors are exposed to both public markets and private markets. In order to maintain target weights in their portfolios, they must rebalance into these private assets. And so the relationship works in reverse as well. When public markets underperform, we see VC investment decrease, and this is at an annual level. So this helps to explain some of what we've seen over the last year or two. And Andy, how have the public markets performed over the last year or two?
Yeah, so obviously, big stories are that the public markets have just been, completely just going up and to the right. And we can see here, we have charted out some of the, big tech stocks over the past several years. And we can see that they're even outperforming and driving a lot of what we're seeing as far as the public markets go. And so from an LP's perspective, when you have these big tech companies really moving the needle and outperforming, a lot of them are thinking, okay, what's next? How can I get an allocation to that next Facebook, Apple, Amazon, Netflix, Google, how can I get some ownership in that company prior to it hitting the public markets and then accruing value to everyone involved. So there's some pressure there, like seeing how some of those previously venture-backed stocks have been performing in the markets is definitely a push towards getting in that ecosystem earlier. You can also see what we're looking at here is our VC or US VC-backed IPO index. And so what this is showing you is of VC-backed companies that end up listing on the public markets, we're going to track their performance in this index for the next 2 years of trading. So just essentially looking at a relatively short time horizon after the listing, how are these companies doing? And generally tracking the market pretty well for most of the time that we have charted here. But you can see, 2020 has really, 2020 and 2021 have really seen those VC-backed IPOs do extremely well compared to the rest of the market over that time period, with some obvious winners like Zoom, making up a big portion of that increase there. And again, keeping with that theme of, okay, I'm an LP, I see these big tech companies doing super well once they hit the public markets. But also what you're seeing is oops, I think that might be, sorry about that. So also what we're seeing is that a lot of the companies that are getting funded, particularly on on the tech side, they're getting a lot more of their funding and they're accruing a lot more of their valuation while they're actually private, because there's so much capital out there. There's less incentive for Snowflake to go public early when they could in fact take several more rounds of private funding and grow that valuation for the private shareholders before, and get themselves on a bit steadier footing before going the IPO route. And so here we're just contrasting some of the older tech companies that we're all familiar with, how much of that initial 20 billion in valuation was accrued during a time when they were private versus when they were public. And you can see the old guard there, hardly any of that value of that initial 20 billion of value was actually accrued prior to going public, whereas almost all of the more recent kind of big tech companies accrued that value while private. And so as an LP, you're trying to get as much of that upside as you can, and so therefore we see them moving into the actual venture investing landscape rather than getting an allocation at the IPO. So you can see that play itself out in the data. On the left-hand side here, we're seeing the percent of total capital invested in mega deals. And so, for example, in 2006, just under 12% of the capital invested in the US was accounted for by investment in mega deals, those deals being 100 million or more in deal size. And that number is up to just under 60% in 2021. So essentially what we're seeing is a barbelling where those big deals are occurring more frequently, and they're getting much bigger. And then, as we've kind of alluded to on the right-hand side, we're looking at participation in the capital outlays by non-traditional VC investors. And so what we're talking about there is, we're seeing a lot of hedge fund activity, we're seeing mutual funds, we're seeing sovereign wealth funds, we're seeing corporations. A lot more corporations are raising CVC arms, things like that. And so you can see a steady march upward and to the right of participation in that actual capital being put into the market by deals that involve non-traditional venture investors. Another trend on the investor side that we're seeing is that the most active investors are becoming more active. And so what we're looking at here is the percentile as measured by deals done. Sorry, we're showing the investor percentile as measured by deals done, and the percent of capital that accounts for, or of deals that accounts for in the market. And so, for example, in 2020, the top 1% most active investors participated in over 40% of the VC deals done. And you can contrast that within 2009, that value was down at 26% or 25.6%. So, you know, the most active investors are just becoming more and more active. We're also seeing a bit of concentration of where those dollars are flowing from an industry perspective. So what we're looking at here is a Herfindahl-Hirschman index methodology applied to capital invested in US VC deals across our industry taxonomy. And so you can see, you know, a shift from 2006 up and to the right to 2021, where we're seeing, you know, essentially more dollars going into a fewer, you know, a less spread out number of industries. And we can see that here we're looking at the change in the share of capital for each of these industries that we're looking at. And so, you know, not surprisingly, software has continued to gain ground. IT hardware is a big loser here, which is also not surprising. And then also, you know, increased interest in consumer goods and services, transportation. That's going to be things like, you know, Uber and self-driving cars and you know, sort of the last mile types of startups as well. And then, you know, one interesting thread that we hear a decent amount is, you know, about geographical dispersion of dollars. And, you know, there's a lot of talk about companies moving away from the Bay Area and New York and Boston and some of those, you know, expensive ecosystems to actually function in to other parts of the country. You know, in favor of lower rents and more favorable tax situations and things like that. And you know, while we do see some of that happening, really what we see happening is there's a lot of money and it's kind of going everywhere. And so you can see in this map here, you know, most of these, well, I think every single one of these ecosystems that we've highlighted here in 2021 has already surpassed their prior annual record for the amount of capital that this area receives. And many of them are nearing already their deal count numbers. So there's a ton of capital, you know, going to these other ecosystems besides the Bay Area, you know, New York, Boston, but it's also still largely flowing to those places as well. So essentially, we're just kind of awash with capital. And here, I just wanted to highlight a couple of, you know, the notable deals from Q3 in 2021. And so this list is just deals in Q3 2021, which is pretty surprising when we look at the top. You know, this is the top deals by deal size. 7 of the top 10 are $1 billion or more, which is pretty remarkable when you consider that in all prior years, excluding 2021, there have only been 37 other $1 billion plus financings. And so it just really speaks to the amount of capital that is really being put to work there. So now we're going to kind of transition into, okay, you know, what's going on with that? We're seeing that the market is flush with capital. So what's going on? What's driving that? Where is that capital coming from? And you know, on the flip side, who is that going to, and why?
Yeah, so one of the first data points that we would look at when trying to figure out the supply of capital or how much is actually available to startups is by looking at mega funds. And mega funds are VC funds by traditional VC firms that have closed with over $500 million. And the trend is up and to the right since 2014 or 2015. So you see more vehicles, you see more capital being raised that's attributed to those funds. And just to give you some context, in 2021, we just crossed the $100 billion mark a couple weeks ago, I think about a week ago, actually. So about 60% of that is attributed to these mega funds. So a lot of capital flowing into concentrated investors that can write these large checks to create these mega deals or participate in these extremely large deals over $1 billion, over $500 million. And when we look at the capital that is the dry powder that's available to be invested into the market, and dry powder is just a collection of all the money that could be invested. We see that number at $238 billion as of Q2 2021, and it's the most that we've ever seen. But I think what's interesting to note is that almost 80% of this was raised in the last 3 years. So there's a lot of new capital that's come into the market recently and still has time to be deployed. So we think that this deployment will span the next couple of years, and there'll continue to be funds raised in that time as well. So there's just a lot of capital in the traditional VC investor side of things. And also when we look at the non-traditional VC investor space, we see a record amount of dry powder available. And non-traditional investors are investors like hedge funds or sovereign wealth funds that may not consistently or traditionally, as the name implies, invest in the VC space, but they may make a deal here or there because the return characteristics are good for them. And corporations also fall into this category. So some corporations set up CVC arms so they can invest in new technology and acquire teams and IP that they're interested in and strategically would benefit their business. And what we see when we look at the liquid assets on their balance sheets, moving from 3 trillion to about 7 trillion from 2010 to 2021, we see a lot more capital on the balance sheets of these companies. So we're not saying that, we're not making a judgment about the proportions that are going to go into the VC ecosystem from this balance sheet cash, but we would expect that there's more incentive for corporations to set up CVCs and to start to participate in this environment. So it's an interesting trend that we've seen and we're keeping an eye on. And as we contextualize this with the amount of VC deal making that has been occurring, we've come up with this metric called total capital sought. And what this metric aims to do is calculate or estimate the pace of deal making. And we start at the company level and we look at historically how often do these companies raise, and then how much do they come to market for after having raised a round, so we know what the difference is going to be, and a few other things that we estimate about the market. This is over about 130,000 deals since 2006 in the US. So we have a pretty large set of data to work with. So we make this estimate based on what we expect companies to come to market asking for. And it tracks deal making pretty closely up until Q1 of 2021 when deal making explodes. And we see investment exceeding what we would expect, what the pace of capital raises should be. And this is partially due to companies raising larger rounds, but it's primarily due to companies raising those rounds more quickly. So they're not coming to market with as much of an ask, but they're making those asks way more quickly.
Yeah, I would add to that we've, just anecdotally, having spoken with some venture investors, they're telling us that their portfolio companies are coming back to them a lot more quickly to raise their next round of funding. And it's almost a constant check-in that they're doing with these companies because they're just looking to turn it around and raise some more capital.
Yeah. And when we apply this capital sought metric to that dry powder that I just showed you, we create a ratio of supply and demand of this capital. So what you're looking at here on the left side of the screen in 2010, there was something like $10 to $14 for every dollar demanded by investors. And we see this ratio slowly shrink until it levels off around 2016 at $4 to $8 of supply for every dollar of capital demanded. And so this is a trend that it's advantageous for investors. While we are seeing record dry powder and record deal making, the ratio between the two is still such that investors, they have more sway at the negotiating table for this reason, because their dollars, the scarcity of their dollars is increasing. And as we, okay.
I would also just add there that, you know, despite the fact that that imbalance has kind of shifted a little bit over time, like, you know, it's nowhere near a 1-for-1, you know, ratio there of dollars sought versus dollars available. And so still having $4 to $6 per dollar sought is a lot of capital available. Absolutely still.
Yeah, it might not be perceptible to startups, but it is a trend. And when we combine all of that data with other data that we capture on deal terms, so things like liquidation preferences and anti-dilution clauses for these deals in the US, we combine all of that information and we create this VC deal-making indicator, which attempts to quantify how startup-friendly or investor-friendly these market segments are. So you're seeing a comparison here between the early stage and the late stage, where startup friendliness is a lower number and investor friendliness is a higher number. And we've seen since 2016 that it's shifted to be 2 to 2.5 times more startup friendly than it had already been. And interestingly, the supply and demand of capital ratio is the only ratio that is in favor of investors, or that's trended in favor of investors. Every other metric that we use to build this indicator has either remained neutral or has shifted to the startup favor. So things like how much are the investors taking of the company when they make a deal has decreased, things of that nature. And there's a methodology to this that we can talk a little bit more about or share the note with you on if you're curious about that. But continuing on, one of the things that we also do at PitchBook is, from a supply side of capital equation, we track impact fundraising. And impact fundraising is just when a fund is trying to make a societal impact or use their leverage at the portfolio company level to make some change while also making a dollar. And what we've seen in the VC space is that the amount of capital raised by impact funds has been relatively steady from 2006 to 2019 at around $1 billion. But in 2020 and 2021, we're seeing multiples of that raised. And interestingly, the count of those vehicles has decreased. So on a per fund basis, you're seeing much, much larger impact funds. And going a level deeper, we also apply what's called the IRIS Plus framework to these funds. And the IRIS Plus framework is just it's a taxonomy of which funds are focused on which causes, and some trends that you can pull out here. Some consistent causes people are able to raise for are education, health, and in 2021, most funds raised in the impact space were focused on energy. So there are a couple places where we do see some consistent fundraising from that perspective. And as companies move through the life cycle, exits are what everyone is trying to achieve. So Andy, how are exits, how have they been performing over the last year?
Yeah, so, you know, here what we're looking at is we're looking at, you know, US venture-backed company exit value, and that's broken out by the 3 different sort of main exit venues. So acquisition, buyout just being, you know, by a private equity firm, and then public listing. And so some pretty remarkable numbers here. Obviously 2020, despite all of the, you know, uncertainty, the pandemic, COVID, you know, still was a very big year as far as exits go. But again, 2021, even through 3 quarters, has just completely blown that number out of the water. almost 600 billion in capital exited through Q3 of 2021, and as you can see, the proportion of that is accounted for by public listings. So that's IPOs, direct listings, and SPAC, de-SPACing events. 88% of that capital is accounted for by public listings, and so, once again, just kind of circling back to, okay, why is there still, why is there pressure for investors to be putting money into venture-backed companies, and a lot of those non-traditional investors moving sort of down market to get allocation? And this is the reason why, is because we're seeing just an absolute, crazy exit environment. So the pressure is to basically get a piece of that, and then if you're having a lot of publicly listed companies then participating in that upside as they enter the public markets over the longer term as well. So some pretty remarkable numbers there. And again, just wanted to highlight some of the notable exits that we've seen in 2021 to date. So a couple of direct listings on the top there with Coinbase and Roblox. Only one de-SPACing event on there with Ginkgo Bioworks, but all of those 10, over $10 billion in value, that's going to be, redistributed to LPs. So some pretty mind-boggling numbers that we're seeing here. And again, just to kind of underpin that point again, is this chart we're showing the top decile in the VC-backed exit size. And so you can see a pretty steady trend for, from 2010 up until about 2019 with some volatility there, but kind of hovering, between $500 million and $1 billion for that top decile exit event. But that number just really shooting up over 2020 and 2021. So some pretty remarkable, potential upside for investors looking to invest in, venture-backed companies. And just kind of looking at the direct listing side, I think that has been over the past several years an interesting topic that's come up. There's been, between this and SPACs, sort of people think of it as, okay, this is a different route to the public markets. It's going to upend the IPO process, and companies will choose to go either the direct listing or the SPAC route, and the IPO process is dead. You hear that, and what we've seen is that's been happening a little bit. There's been a handful of those, some notable ones, of course, and just on the post-listing performance, it's been mixed. So not certainly a panacea to those those first day pops, and just sort of not necessarily the answer to supplanting the IPO process. There's still a healthy environment there. And then on the SPAC side, I'll let Alex kind of wrap up with this.
Yeah, when talking about exits and paths for companies to achieve public listings, we'd be remiss if we didn't cover SPACs. It's in the news almost every week, a new company raising a SPAC. And just for some context, there have been over 400 SPACs registered in the US this year, so it's more than one a day. And here you're looking at a chart of the announced versus the completed SPAC registrations in the US. And what should catch your eye is that there's a lot of SPACs that have been announced but haven't actually made it into the market. So there is a backlog of SPAC capital that we expect to either make it to market. Some of these deals may fall apart, or these registrations may fall apart, but there's more to come. And when we pair this up against de-SPACing activity, what we see is that SPACs announce or complete a registration at 2.5 times the pace that they close with a de-SPACing event, either announced or completed. And interestingly, June is the only month where there were more de-SPACing actions than SPAC registrations. And in the month of September of 2020, there were actually no de-SPACing actions. And it's there was 1 month without de-SPACing actions. There have been no months where there was not at least one SPAC that was announced or completed in registration. So it looks like there is quite a bit of SPAC capital out there, but from my perspective, it might be the case that we're hearing about it more in the news than we necessarily need to. It is still a viable option for companies to enter the public markets via, but the question now becomes how many of these SPACs are going to have to return capital as they come up on that 2-year window after having been registered, that how many are going to have to give back capital to their investor base. So that's something that we're keeping an eye on and we'll continue to cover. And here is some accompanying research. I mentioned earlier that we would talk about the methodology for the deal-making indicator. There's a note on the top right of the screen here that you can access that will walk you through how that's calculated, how we calculate capital sought and determine how many companies are coming to the market, so on and so forth. If you were really interested in the impact fundraising segment, we have a note on sustainable investment surveys from 2021. We have about 500 responses from GPs, LPs, VCs on their preferences and perspectives on ESG and impact fundraising in general. And by the same analyst, Hillary Wick, there's another note that dives deeply into the IRIS Plus frameworks. What are the fundraising trends that we're seeing in terms of the causes that are being supported? There's about 15 pages of really, really interesting content there. This is all available in our research center. So feel free to check that out.
I'd also add that if you're more specifically interested in specific technologies and sectors, we have an emerging technology team who's focused on 1 or 2 verticals, and so I think it's 12 or 14 verticals we have coverage for right now, and so that includes things like fintech, decentralized finance, climate tech, health tech. Pharma and biotech, and there's a lot more that I honestly, mobility tech, so things like that. There's a bunch of them. So if you're interested in any of these pieces of research here or any of the other sector specific stuff, we can certainly help you find some of those resources there and get you in touch with some of the analysts at PitchBook. And that's it.
Yeah, thank you for your time.
Yeah, appreciate it.
Thanks, Alex. Thanks, Andy. If you stop your presentation so people can see each other, and the floor is open for the questions, and to kickstart the conversation, I started my question. Constantly, I saw your hand, you'll be next.
Okay.
So I think it was quite fascinating when you went through that 10-to-2 yield curve compared to the other financial crises. It would be fascinating to see the shape of the curve, which is a normal or inverted. I have my own theories, but we would like to see the data at some point. But the discussion that you had about the role of LPs and their willingness to go for such a high valuation and the environment becoming more of a startup friendly based on the index that you define. With so much money going to VC capital, especially the larger fund that you said, where do you see the landscape on the early stage of investment? I'm talking about seed to Series A level type of investment.
Yeah, so obviously sort of those headline numbers, as you alluded to, are pretty focused on those huge deals. They're showing, those top 10 deals, 7 of them being $1 billion or more. So, that's obviously going to be the big needle movers. But on the lower end of the market, we are seeing actually a lot of micro funds, which by our definition is $50 million or under. And so activity there is actually quite robust. That is definitely, that side of the market is not being ignored. I think we're seeing a bit of a barbelling there of firms that are, maybe not your most established and large venture firms, kind of pivoting towards those earlier stages because they're not able to compete as much with some of those large check sizes and valuations. You also do see, a number of the more established firms like, Andreessen and Graycroft, for examples, that do have dedicated vehicles investing at those earlier stages. And, I think what we see is that, yeah, despite the fact that there's so much activity and money going to those the top end of the market, the traditional venture investors are keenly aware of what their pipeline is, and so they understand that if they want to continue deploying capital into businesses that they deem to be worthy of the valuations that they're fetching right now, they do kind of have to massage that pipeline and make sure that they have a source of future investments. So all that to say is, activity at those early levels, we didn't have it charted out here for you, but it is also going up and to the right, and we are seeing a lot of activity and capital going there as well. It just doesn't quite move the needle, as much as those billion-dollar transactions.
Thank you. Konstantin, please.
Hey guys, that was a great presentation. Thanks for doing that. Just by background, I helped start a seed stage fund called Launch Capital back in 2008. And that was an interesting time to get into the VC game. But I'm wondering now, specifically with some of the heat or bubble, if you will, in the climate tech space, if you're seeing a lot of these mega funds, or even I guess traditional VC funds, starting to do indirect investing into each other, so doing fund-to-fund investments versus direct investments, due to sort of a lack of supply of deals and pipeline. Have you guys seen that sort of activity?
More anecdotally than we can pull out in the data. I mean, you definitely have been reading some stories about that happening, I think I guess it's a little bit more on the private equity side, but the GP secondaries are kind of picking up a bit, where you have people actually taking a stake in the management company. Not as so much on the venture side, I guess. Yeah, we have been hearing a little bit about that, but it's not something that we're able to really tease out in the data very easily, unfortunately.
Yeah, that'd be cool to kind of see what the the inner sort of deal effects are. Yeah, that'd be cool.
Yeah, we'll definitely make a note of that and see if there's anything we can come up with.
Okay, thanks, guys.
Any other question?
Yeah, this is Richard Guha again. That was excellent. I mean, almost so compressed that it was like so many questions arising from it, some of which I may be able to answer from some of the information sources you mentioned. One sort of more general and not necessarily important, it depends on what your answer is. You'd mentioned SPACs, which obviously is in the press a lot and media as a whole, and in passing you talked about strategics, but I'm curious as to how in that early stage world, so we're not necessarily talking huge dollars, but we're talking spread across a whole lot of company, people like crowdfunding, Reg A, Reg A plus, the strategics, how that has changed the world in a sense later on, where the bigger dollars are, but where there's a lot of activity. I don't know to what extent you look at those, but any sense for how that has changed the map of the world for later on?
Well, I can say we have some coverage on crowdfunding and product funding, or product crowdfunding, equity crowdfunding, the split between the two. We do have some coverage on that and some notes. Specifically, Andy, I don't know what your thoughts are on that.
Yeah, I guess I don't know that I have too much insight into that side of things. So is your question more just like,
well, let me expand on it a bit. I know an awful lot of people who are madly sitting out there going to the usual suspects, the me funders and we funders and the whatever else, and it seems to have a lot of impact at the entrepreneur level. Not necessarily big bucks, but we're talking 100,000, couple 100,000 maybe. The Reg A plus, again, that tends to be companies with people are using their patents as securities to try and do a bit like a SPAC, a sort of a backdoor IPO. And there are people who do that. There are sort of small investment banks, whatever they may call themselves. They call themselves investment banks, actually, who do that kind of stuff. And it does seem to, when I deal with early stage entrepreneurs, it's very salient in their minds. And I'm wondering how real that is, whether it's just in their minds or whether it really has an impact.
Yeah, to be honest, I can't really speak to that too directly. I mean, we definitely see a lot of activity at sort of the angel investor level. You know, we do see a lot more people, just sort of individuals who have some capital and who have a, you know, accreditation, getting in and trying to kind of get into the funding environment. I mean, there's a lot of deals that you see, particularly on the smaller end, that have a lot of, you know, sort of a consortium of angel investors involved, that, you know, is definitely driving a lot of the activity at some of the smaller, end of the scale. I'm not as familiar with sort of the patent side of thing like you were alluding to.
Okay.
Yeah, I would just echo that. Looking at the angel data, it has been increasing. It's an area of growth that we see in the market, but we haven't seen the crowdfunding stand out the same way. And so I think that that's probably a brighter spot, the angel or multiple angel side of things.
I'm fairly skeptical about both the crowdfunding and the Reg J stuff, but you know, so many people come to say, "Oh, I've been told I've got this great opportunity, I can do this," and I don't have the data to tell them that they're maybe should look elsewhere.
Yeah, we can definitely look into that and see if there's anything that we have. You know, that's a pretty small side of the market, and so it can be tough to track.
Yeah.
From a data
Dollar-wise, I know it's
perspective.
small, but there are just an awful lot of entities involved in it.
Yeah, and I think, you know, the relative lack of expertise in actually executing a lot of those deals can be some friction for those companies when, you know, you get someone who's excited about your idea, but, you know, actually getting that sort of follow through can be difficult.
All right, thank you.
Jason, please.
Yes, hi. Thank you. Fantastic presentation and the insights. Actually, besides I'm involved with technology, also I'm an investor. Probably. Actually, you mentioned some company called Roblox. Actually, that stock went up 40% yesterday. Now it's come down 13%. Does your pitch book tracking on the follow up, you know, the performance of the IPO, post IPO? Because as a experienced investor, always know the phenomena called pump, dump, you know, high pump and dump. Have your pitch book looking into this, you know, the phenomena, and how do you protect, you know, the most innocent investors?
Yeah, so to answer your question about the, you know, whether we track that, yes, we do. You know, from a data perspective, when a company goes public, we then start piping in their, you know, all that kind of public information on that company and display that to our users. From a research perspective, we don't do a lot of coverage of the public markets. You know, we'll certainly continue to follow some of the notable, you know, VC or PE backed companies that go public and do some sort of qualitative analysis, but we're really not focused on covering, you know, public market trading strategies and a lot of those kind of like you say, those phenomena with the pump and dump schemes and things like that, or, you know, we're not really tracking meme stocks and stuff like that. So we're from a research perspective, we're mostly focused on the private markets, but we do, you know, sort of follow some companies, you know, into the public markets from a research perspective. But we do have that data. So if you're a user of the platform, you can get all that data just all consolidated into our profiles.
Yeah. How do we contact you to get you access those research information, as you mentioned? How do we contact you?
We can share out our emails, and you can get directly in touch with us after the presentation, and we can kind of route you in the correct direction.
Sure. Thank you very much. Thank you.
Sure.
Any other question? If not, I want to ask the last question before we get to the top of the hour. You know, you mentioned about this overvaluation of private assets, which is going to create some kind of imbalance in the fund managers. As you know, the VC asset class is typically considered high risk, and they're trying to maintain certain proportion. Sometimes they say 6 to 7% of the assets. But because of this overvaluation, suddenly they have to rebalance if they want to stay with the traditional level, which means that some of these free cash available in the VC market may not be available in the long run. So looking at your crystal ball, two-part question, and you will be held liable for your answers. One is, do you think this capital trend is sustainable? And if not, do you expect any kind of correction in near term?
Well, you never want to be in the position of having to call a peak, but I think if you look at the data, there are the first thing to think about is that there is a lot of dry powder out there, and it has been raised very recently. So there are some legs for this market to stand on with respect to the capital available to startups. And the other thing to think about too is that we just recently did an analysis on how often do markets look overvalued, and we found that 50% of the time, the VC deal investment is at the 90th percentile of greater of all the times passed from that point in time. So what that's roughly saying is that it does tend to look like this is an incredible amount of VC deal investment, and it compared to the past, it is at the 90th percentile. So it seems like it has room to run. I don't know, Andy, what are your thoughts?
Yeah, and I think I would say, the point on that, right, is like there's been a general trend toward the industry over time. So it's kind of been up and to the right, sort of in a general sense. I mean, looking at the numbers that we just saw, like it seems hard to imagine that it would be sustainable at the levels that we're seeing now. But to Alex's point, we just also looked at the mountain of capital that's out there that is, dedicated to investing in these companies. So there's at least some runway for additional, capital in the markets, which, is unlikely to completely dry up. I think, to your question more specifically, for your sort of non-traditional investors who tend to be participating in those really, really large, top of the market deals, I think it would take something pretty extreme to make them move completely out of the space. We saw a pretty early 2020 when the pandemic was still in the most nebulous stage, big market drop. And then we saw what just came out of it, just a complete rip of the market. And so, if something like that, if an earthquake like a COVID, pandemic is not going to avert attention, it's hard to see, outside of something like a geopolitical, large scale event that would really pull dollars, in such a sudden way to see a massive downturn. I mean, that being said, there's only so many $billion+ deals that it seems like you can sort of do, but we're continuously surprised. So I know that's extremely hedged answer. I just don't want to be held liable for calling the top of the market and all that. But
I thought my lawyer was answering my question. So I think we are reaching at the top of the hours. But back to that comment, this is an environment that we have seen many times. With a slightly different scenario. Part of overvaluation and not the capital market, especially public market, not matching the fundamentals to support it. Either something in fundamentals has to change, or there has to be some correction to match it up. Changing fundamentals are not that easy. It doesn't happen so rapidly. So I think that you can read the answer between the line that something has to change to match up these things. But I think that's more of a, I would say, the mega scale of looking at the capital market. Looking at the time, we have reached the top of the hours. So this is the end of formal presentation and discussion. But Alex and Andy will be online. We are going to keep the line open if you have any questions, comments that you want to make with them. All right. And those who want to leave, thank you for joining and have a good day.
Yeah, thank you.
Yeah, I didn't ask it as an additional question because you did say that the data was available and some of the stuff you had, but the whole thing of industry, and you said there were about 12 industries, 12 to 14 industries you were covering. Any headlines to how things have shifted in the last few years? Let's say since COVID started, because that seems to be the point of discontinuity. And any sense about which industries have rocketed up and which industries have fallen apart? And I know I'm exaggerating, but
Boy, that's a good question. You know, like we kind of pointed out in that slide, like these aren't industries that we cover from the emerging tech side, but you know,
Right.
IT hardware dropping, obviously software, you know, obviously sort of anything that sort of enables the remote environment has just been completely going bonkers, as you'd completely expect. You know, the emerging tech verticals that we try to cover are things that, you know, are generally kind of on the upswing, and it's a relatively new sort of facet of our coverage. And so I don't think any of the verticals that we're covering right now are sort of tanking. I think we're trying to hit them on the upswing so that we can, you know, there's a belief that they're kind of a meaningful future there. I don't know, was there anything else that you came up with, Alex, or can think of?
Nothing faltering, nothing falling apart. No industries are standing out that I can think of. We did just initiate quite a bit of coverage on climate tech, and we divided it essentially into two different kinds of verticals, but climate tech and then another set of technology that focuses on the human relationship with the earth into the future. So maintaining our systems, but cleanly. And we've seen a lot of interesting technology come out of there. So that's an interesting sector that we're keeping our eye on. But
Yeah.
all that research is available in the research center. Sorry, Andy.
That's why I didn't ask it before, but I thought
Yeah.
may as well ask now.
That's fair.
No, I think it's interesting too to keep an eye on, you know, what potentially comes out of the infrastructure bill that just passed. I mean, that's a massive pile of money dedicated to a lot of the traditional infrastructure sectors, and I would imagine that there's going to be some pretty cool, innovative companies coming out of that.